Global markets remain pessimistic on growth, but a widening in credit spreads has implications for investors. To find out more, we're joined by Dr. Stephen Nash from FIIG Securities in Sydney. Stephen, why are these 10-year bond yields so close to that 4% mark at the moment?
The bond market's been quite pessimistic on growth for a while. The low in 10-year bonds in the crisis was about 386, so we're approaching that low right now. I think the difference this time is that expectations are for an improvement in growth, but nothing as rapid as we saw after the crisis. So I imagine that some of these bond yields will probably go a little bit lower than they are and then head a bit higher. But with the rise in credit spreads, we're getting some really good opportunities with some of the major bank bond yields and also some of the European names, with yields up to about 8%. So even though fixed rates are rallying, the credit spreads are offering really good value for some of the investors right now.
With everything going on in Europe at the moment, are Australian banks having difficulty in those global funding markets?
Look, I think Australian banks would like to think that they're in their own world and that they can issue wherever they would like to, but the fact of the matter is they're connected to a global system, and some of the major systemically large banks are having difficulty funding right now. We're seeing credit spreads on a lot of the securities blow quite a bit. For example, a 2016 BNP bond, the credit spread is blown in the last 3 or 4 months about 300 basis points. So the cost of funding for these banks is gone up dramatically, and Australian banks are not immune from that.
We saw that job claims data out in the United States overnight. Was that a real positive for growth expectations?
We've seen a series of releases in the US which have been quite positive for growth. I think the market is getting a little bit wrong-footed here in the sense that they're concentrating on the European problem and they're expecting that that will impact US growth, but it doesn't seem to be appearing right now. So I imagine that the markets will focus on these fundamentals at some stage and rally into Christmas. Yeah.
And what are the broader implications of the euro crisis? Can you talk us through that for global growth and growth here at home?
Well, what's happening is that people are expecting some difficulty with funding of European banks, and the US banks are looking at their exposures to European banks. If there was continued crisis or some event in the European situation, that will affect the banking system globally. I think that's the real implication here. What does this European crisis have on the banking system? And it's not positive. Basically, we're seeing credit standards being tightened at a time where they really need to be loosened. So what we need is people to be able to get credit. It's not about the price of credit, it's the availability of credit that's very important right now.
Not a good week for the global banks. Thanks so much, Dr. Stephen Nash from FIIG Securities in Sydney.
Thanks a lot. Bye.